Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028-201. He is a gentleman. He is a scholar. He is
Tyler Cralle.
Well, we got ourselves a new Fed chair. Yep. Senate voted. Confirmed Kevin Warsh. And so he takes over the job on Friday. And I'm sure he's looking real forward to it with all that is happening right now with markets. We got another bad inflation report today. A not so great 30-year Treasury auction. We're going to get into all of it. But we got a new Fed chair. So welcome, everyone, to the Thursday edition of Wilmington Mortgage. I am the aforementioned host of this podcast, Tyler Cralle, of course, loan officer at Town Bank Mortgage right here in Wilmington, North Carolina, where we break down the top stories impacting mortgage rates every single weekday, unless, of course, I'm sick, on vacation, or it's Azalea Festival week, and none of those are happening. So away we go. So, 54-45 vote to confirm Kevin Warsh as the 17th Federal Reserve chairman. It was a party line vote. Only one Republican or only one Democrat voting with the Republicans. That was John Fetterman of Pennsylvania. And it was the narrowest margin since they began this process back in 1977 of the Senate having to approve the Fed chair. Jerome Powell, whose tenure ends on Friday, but not his term on the board. He's going to stay on the board, as he has made perfectly clear. He got at least 80 votes during his two confirmations. Previous chair, Janet Yellen, got 56 votes, only 26 opposed. Many senators were absent because of bad weather. But, I don't want to get in politics, but we really have reached kind of a problem with the Senate confirmation process. The Senate is really only supposed to look at someone's qualifications and be like, okay, this person's right. It's not about, in my opinion, it is not about do you agree or disagree with the ideology of the person taking over the position. The president, the people elect the president to make those choices. And the Senate's job is to then say, okay, we're going to make sure they're qualified, which they don't always do. And if they're qualified, I might disagree with them, but I'm going to vote for them. And that's, if you go back and look at confirmation votes, that's how it used to be. And then things started getting political. Won't say when. It was a while ago, though. It was not like, it's like 40 years ago. Things started getting political, and now here we are. And every vote's going to be like that from now on. It's like impeachment votes. I'm actually surprised. I guarantee you, we've now reached the point where every president's going to get impeached by the other side, regardless of whether they committed some horrible act or not. But all right, done with politics. I just am not a fan. I think Kevin Warsh is qualified, whether you agree with him or not. The 54-45, but I don't know. He should be getting 80 votes. It's like, and I'm not 100%. I like Kevin Warsh. I think he's going to be good. I don't agree with him on everything, but he's qualified. He's qualified for the job. President wants him. That's the way it's supposed to work. So, all right, off my soapbox. Just not a fan of what Washington has become. So, all right, we got Warsh going to be the next Fed chair. There's actually a good op-ed in the Wall Street Journal about, oh man, Warsh is going to be taking over at quite an interesting time. And what's the famous Chinese? Is the Chinese proverb where it's like, may you live in interesting times? Is it adage or proverb? Whatever. But he's going to be taking over during interesting times. There's no doubt about that. All right, let's jump in to the inflation report that we got today. So we got the CPI report. That was out on Tuesday. That was not good at all. Now, I don't think it was as bad. That was sort of the theme of yesterday's show. While it was bad, it was not as bad as it could be. And there was a piece today in the Wall Street Journal about looking at the CPI report, saying that there is concern among investors. We are seeing warning signs. I mentioned this yesterday. There are some warning signs about potentially entrenched inflation. But for the most part, we're still not seeing a sign that, oh no, this energy shock is going to be long lasting. Definitely short term, but not long lasting. And so because of that, and like I said, this was confirmed. The Journal piece, Sam Goldfarb wrote that, interviewed some people on the street who sort of made that, for Wall Street, not like man on the street interviews. Hey, do you guys think inflation's entrenched? And then there was a good piece by Robin Brooks, of course, the Brookings Institute, over at his Substack, in which he said, listen, I don't necessarily always agree with, some of these policies and everything else, but if you look at the CPI report and remove the noise, there is not a big concern about, he's not seeing signs of a real threat to higher inflation long-term, midterm, and long-term. But today we got a PPI report on Wednesday, and not good. This was actually way worse than the CPI report. So PPI, of course, Producer Price Index. This was bad. So the Bureau of Labor Statistics reported that producer prices jumped 1.4% for the month. So prices were up 1.4% month over month from March to April, 1.4%. That was double the 0.7% increase that we saw in March. That was bad. And that jump is the biggest jump since March 2022, which what was happening then? That was when we saw inflation take off. So that is a scary number to see that. Economists had expected a smaller 0.4% increase. So they were off by almost a factor of 4. But let's give them the benefit of the doubt and just say 3. On a yearly basis, producer prices are now up 6% when compared to the same time last year, up big time from the 4.3% in March. And that is the highest annual inflation rate since December 2022. So a lot of comparisons to 2022. That's not good. Services and energy led the spike. Final demand services rose 1.2%, the largest increase since March 2022. Once again, with trade services accounting for much of the gain. Trade indexes measure margins received by wholesalers and retailers. Those margins jumped almost 3% in April. Goods prices also accelerated, climbing 2% after a 1.9% increase in March. More than 3/4 of that increase came from energy prices that surged almost 8%. So once again, a lot of energy shock showing up in this report. Not that surprising. Definitely short-term pain. Not necessarily a long-term gain, but the question is, are we going to see long-term pain? And so the CPI report, the data that we've seen from most people is that no, they're not overtly concerned yet. Core inflation, unfortunately, also exploded. Core producer prices rose 1% in April, up from 0.2% in March, and that was the biggest increase since, March 2022. Annual core inflation is now at 5.2%, the highest level since, December 2022. So there's definitely a theme with this data, no doubt about that. Mohammed El-Erian, I think I'm saying that right, former CEO of PIMCO, Queens College, now as a Substack, said in his latest post, while the mapping isn't one-to-one, these numbers strongly suggest that higher consumer inflation is still coming through the pipeline. And so it didn't really move markets. I mean, I thought we might see some, the PPI report might freak more people out. But not really. I mean, the 10-year was pretty much unchanged for the day after a big jump on Tuesday. And then Mortgage News Daily's 30-year fixed rate index had rates up 1 basis point. So they had the 30-year fixed at 6.57%. So, like I said, a pretty bad report, but a lot of the bad news was kind of absorbed yesterday and reflected in the numbers. And so we did not see a huge jump today. And considering how bad the PPI report was, that's not bad. So kind of going off the theme yesterday, Bad, but not as bad as it could have been. So no real big movement in rates. And like I said, that's a pretty bad. 1.4? What is the number? Actually, let me check that out. I'm going to do the math right here live. Let's see, 1.4. Let's see what the annualized rate is. That's 16.8%. That is crazy. That is a crazy number. All right, we did have a Treasury auction, which was not good. So we talked about the 10-year Treasury auction, which, while down from sort of historical averages, was still stronger than the February one. The 30-year was just dog you know what. So instead of $42 billion, they had just about $25 billion. And the bid to cover ratio, which is a good indicator for demand, higher numbers better, was way down, 2.3, which is, I think, slightly, the 10-year was 2.4. So this is 2.3. And this is way down from the February auction of 2.66 bid to cover. That's a big drop. So that's a bad number. And then what really kind of blew me away was the involvement of the primary dealers. So remember, you got indirect bidders, direct bidders, primary dealers. You really want to see all the activity happening in the indirect and direct bidders. Primary dealers, of course, have to be kind of the other side of the trade. They are forced to buy the bonds when the rest of the market doesn't want to. Back in February, they represented just under 6% of the bids accepted. Yesterday, what day is it? Almost 12%. So almost double. The indirect bidders made up 66.6%. Horrible statistic. 6.6. That's a horrible stat. Down from 70%. And direct bidders were at 21, just under 22%, down from slightly over 24%. So, that is a big jump in primary dealers, which tells you there is not, with a dropping bid to cover ratio, there is not a lot of demand for 30-year bonds. That's a little, that doesn't impact markets the way, like, if a 10-year had been that bad, because like I said, the 10-year was actually up from the February auction. So this was down. This was significantly down. It's not going to impact us because, once again, we go off the 10-year, but it's not a good sign. That is not good. But like I said, markets did not react too heavily to that versus, say, like if there was if a 10-year had been like that, DEFCON, I wouldn't say, probably like DEFCON 4. You know what? I always forget. It's the higher the number is the worse, right? How does the DEFCON system work? Let me look that up. You know what? I always look it up, and then I never remember what it is. Okay, sorry. Reverse that. 5 is the worst. 5 is the best. 5 is normal. We're always in DEFCON 5. 1 is we're on the verge of nuclear war. So if we had a 10-year auction that bad, we probably would be at DEFCON 2. But as of right now, like DEFCON 4 is where we are. Okay, so DEFCON 1 is worst. DEFCON 5 is... Okay, all right. I'm trying to remember that. Remember, I always forget. I always look it up, and then I forget to look. So, all right, DEFCON 1, bad. DEFCON 5, normal. 1, 5. All right. I think we're good. All right, so very busy week so far, as you can tell. Today we're going to be getting retail sales and jobless claims. So a little bit calmer of a day, unless, retail is really, really bad or some crazy jobless number. But a little bit of a reprieve from kind of going towards the end of the week. I think the only thing on Friday is consumer sentiment, Michigan, I think. Not Michigan. I think another consumer sentiment report. So not a lot going on. We've gotten through the worst of it, and and as bad as it wasn't as bad as it could have been. All right, we're keeping that going as we move forward. We got a new Fed chair, though. All right, you guys enjoy your Thursday. We'll be back here Friday for another edition of Wilmington Mortgage. And remember, as always, do not wait to buy real estate. Buy real estate and wait.